Picture two people starting with the exact same amount, $100,000. One puts it into a broad stock index fund. The other uses it as a down payment on a $500,000 house. 30 years later, both might call themselves millionaires. But they got there through two completely different machines. One owned small pieces of businesses, the other controlled an asset 5 times larger than the cash they started with. And that's exactly why the usual stocks versus real estate debate is almost always built on the wrong math. People usually compare the stock market's return with home price appreciation, and whichever percentage is bigger wins the argument. History does show that U.S. stocks have produced a much higher headline return than residential real estate. According to a long-running NYU dataset, $100 invested in the S&P 500 in 1928, with dividends included, grew to roughly $1.16 million by the end of 2025. The same $100 in real estate grew to only about $5,626. That works out to roughly 10% a year for stocks, versus about 4.2% for housing before inflation. That looks decisive, it isn't. Because the stock number includes the full return from owning businesses, dividends, and all, the real estate number doesn't capture the actual financial experience of a homeowner at all. It leaves out borrowed money, mortgage paydown, rent avoided, tax treatment, and maintenance. So what's the real question here? It's not which asset has the bigger historical percentage. It's what each asset actually does with every dollar you put into it. And to answer that, we first need to understand how the stock machine really works. The machine behind stocks. When you buy a broad index fund, you're not buying a number on a screen. You're buying small ownership stakes in hundreds, sometimes thousands, of real companies. These businesses sell products, earn revenue, hire people, build factories, write software, raise prices, cut costs, and fight for customers every single day. If their earnings grow, your ownership claim can become more valuable. Some companies pay out part of their profits as dividends. Others reinvest that money back into the business. Others buy back their own shares, shrinking the number of ownership claims outstanding. This is productive capital. Your money is tied to businesses that are actively trying to create more money. That doesn't mean stock prices move smoothly. They can fall 20, 30, even 50% and stay disappointing for years. But the underlying source of return isn't just someone else might pay more tomorrow. It's that profitable companies generate cash, reinvest it, and grow. Now compare that to real estate. A house doesn't manufacture anything. It doesn't write software. It doesn't earn corporate profit. Its value comes from scarcity, location, replacement cost, population growth, income growth, credit conditions, and zoning, plus the simple fact that people need somewhere to live. Nationally, the Case-Shiller Home Price Index rose from a baseline of 100 in January 2000 to about 331 by April 2026, meaning U.S. home prices more than tripled. But annualized, that's only about 4.7% a year, nowhere near an explosive double-digit return. So how does real estate manage to build so much wealth for so many people? The answer lies in a weapon that ordinary stock investors almost never get access to. Leverage, real estate's hidden weapon. Say you buy a $500,000 house with $100,000 down. You now control a $500,000 asset, even though only $100,000 of it is actually yours. If the home rises 4% in value, that's a $20,000 gain. Measured against the whole property, that's just 4%. But measured against your own $100,000, that's a 20% gross gain. Before interest, taxes, insurance, and maintenance, and leverage cuts both ways. If that same home falls 4%, your $100,000 in equity takes a $20,000 hit. That's also 20%. The house barely moved. Your equity moved 5 times as much. This is exactly where most casual comparisons fall apart. Real estate looks like it creates extraordinary wealth, not because the asset itself compounds faster than stocks, but because buyers get access to large amounts of relatively cheap, long-term debt. Try walking into a bank and asking for a $400,000 loan over 30 years to put into an index fund. For most households, that loan simply doesn't exist. But for a house, it's completely normal. Now add amortization into the mix. every mortgage payment is split between interest, which is the lender's charge, and principal, which reduces your debt and builds your equity. Early on in a typical fixed-rate mortgage, most of your payment goes toward interest, not principal. Take a $400,000 30-year mortgage at a hypothetical 6.5% rate. The monthly payment comes out to roughly $2,528. In the first year alone, the borrower pays over $30,000, but the loan balance only drops by about $4,500. The rest is almost entirely interest. Over the full 30 years, total interest paid can exceed $510,000. Eventually, the buyer owns the house outright, but that path is far from free. And once you strip away this leverage illusion, the real question becomes, who actually ends up with more money at the end, and why? The real truth, who actually wins? My house went from $500,000 to $1 million. That sentence tells you almost nothing on its own. You'd need to know the down payment, the interest rate, how many years it was held, property taxes, insurance, maintenance, renovations, and what renting would have cost during the same period. Freddie Mac says closing costs typically run 2 to 5% of a home's purchase price. On a $500,000 home, that's $10,000 to $25,000 before a single dollar of equity is built. And Fannie Mae suggests budgeting 1 to 4% of a home's value every year just for maintenance and repairs. None of that ever shows up on a home price chart. On the other side, a stock index fund never needs a new roof. It never calls you at midnight because the basement is flooding. It can be sold in seconds instead of months. But that same liquidity is also a trap because stock prices show themselves every single moment. When the market drops, the loss is impossible to ignore. And that's exactly where the strangest difference between these two assets shows up. Stocks are financially easy to hold, but psychologically easy to sell. Real estate is financially expensive to hold, but psychologically hard to sell. That friction often protects homeowners from their own worst instincts. Forced saving plays a huge role too. A lot of people say their home was their best investment. What they often really mean is that the mortgage was the only investment they consistently kept funding. The payment came due every month, and skipping it had real consequences. The system forced discipline onto them. Now let's run the numbers. That same $100,000, compounded at a hypothetical 8% for 30 years in stocks, grows to just over $1 million. Put toward a 20% down payment on a $500,000 home, appreciating at 3% a year, that property becomes worth roughly $1.21 million after 30 years. At first glance, the house wins, but that comparison is fake because the stock investor only ever put in that original $100,000. The homeowner put in the down payment, 360 monthly payments, taxes, insurance, repairs, and closing costs. In return, they got 30 years of housing, something the investor still had to pay rent for somewhere else. A fair comparison has to put both people in equivalent homes, track every single dollar going out, invest the difference, account for taxes, and value the housing itself. And once you do that, the answer becomes incredibly sensitive to a handful of variables: how long you stay, how expensive the home is relative to rent, how fast the local market appreciates, what mortgage rate you get, how much maintenance the place needs, what the stock portfolio actually returns, and whether the renter genuinely invests the difference. Change just one assumption, and the winner can flip completely. So the real difference isn't really about the asset at all. It's about debt, time held, discipline, and location. Stocks win through productivity and scale. Real estate wins through leverage, duration, discipline, and location. And often, the person who picked the mathematically weaker asset ends up wealthier simply because it was the one thing they could actually hold on to for 30 straight years. Which leaves us with an uncomfortable question underneath this entire debate. Are people really choosing between stocks and real estate? Or are they choosing between two different systems, each one built to control their behavior for long enough that compounding finally has the time to work? Subscribe our channel and stay with us.